for tax disclosed in the annual accounts required to be furnished to the State Bank of Pakistan subject to the provisions of advances and off-balance sheets items shall be allowed up to a maximum of 1% of the total advances, and provisions of advances and off-balance sheets item shall be allowed at 5% of total advances for consumers and small medium enterprises as defined under the State Bank of Pakistan regulations. Provided a certificate from the external auditor is furnished by the banking companies to the fact that such provisions are based upon and are in line with the prudential regulation. The above rule was substituted by the Finance Act 2009, and then further insertion was also made by the Finance Act 2010, whereby a bank can carry over the provision in excess of 1% of the total advances. However, there are anomaly in respect of carried forward provision of 5% of the total advances for consumer and the SMEs. The finance bill now seeks to amend the proviso and to remove the anomaly. So now there is no anomaly regarding the bank's 1% and regarding the carried forward of the 5% of the SME. The another proposal which has been proposed, Rule 6 of the 7th Schedule, which provides that the income under head dividend shall be taxed at the rate of 10%. The finance bill seeks to enhance the rate of tax on a banking company on dividend received from its assets management company, and such a dividend shall be taxed at the rate of 3%, 20%. Let me give you some background. What is happening today? What the banks are doing, banks are receiving deposits from their account holders, and if they themselves invest in the securities or T-bill or PIB, their income will be taxed at the rate of 35%. So what they did, they formed asset management companies, and their asset management companies were actually, managing the funds, and they invested in the funds. And since the funds, if they distribute 90% of their tax, there will be no tax on the funds. They will declare that dividends, and the bank's dividend rate was 10%. So there was an arbitrage of the 25%. Not the gross, I would say net to some extent. So we actually wanted to get hold of this arbitrage. And the provision was made, the suggestion was made that there should be a provision for that. However, the provision which has been given by the finance bill lacks three things. First of all, it says that the dividend received from its asset management company. In fact, asset management company do not take a fund from the banks. It is actually the fund which then also they have tried to brought the uniformity in the law. Presently, the income from debt and profit on the other than except the securities of the federal government, provincial government, and the local government arising to taxpayer other than a company are final tax on such profits. However, the profits earned on securities issued by the government, federal government, provincial government, or a local government is taxable at the normal rates. So now the finance bill is proposing to bring all the federal and provincial government bonds like T-bill, Pakistan investment funds at an equal level, and at the same time this facility has also been given to the non-residents. So the amendment has also been made in clause 5A of part 2 of the 2nd schedule, whereby now non-resident even make an investment in an earned profit on debt, the rate of tax will be 10% and it will be full and final. Now, scope of unexplained income. The scope of unexplained income, which is section 111, has been proposed to also include suppressed production or sales or any amount chargeable to tax and items of receipt liable to tax in whole or in part in addition to amount credited in the books of accounts. any investment or valuable article owned by the taxpayer or taxpayer has incurred any expenditure but fails to explain the same or his explanation is not satisfactorily in the opinion of commissioners as previously provided. It is very important to point out that as you all have experience, when we go for an assessment, usually the sales are increasing, they differ, the revenue officers differ with us for the production, that the production is not correct. So when it is a tried law and there are a number of decisions of the superior courts, that if there is an issue of a debatable and there is debate can be done, it cannot be considered as a concealment of the income or an unexplained income. So I think the ICMAP can also take view on that. And there are a number of decisions like in 2004 PTD 240, it was decided that the rejection of accounts cannot be considered as an addition under section 13. So now it is 111. Now this last point, which is to remove the contradiction in the law. They made also, the finance bill has made also an effort to remove the contradiction. In fact, the section 132 provides that the appellate tribunal shall afford an opportunity of being heard to the parties to the appeal, and in case of default by any of the party on the date of hearing, the tribunal may, if deemed fit, dismiss the appeal in default or may proceed ex parte to decide the appeal on the basis of available record. This provision, in fact, to dismiss the appeal was inserted in 2002. And from there on, all the professional bodies, especially the bar associations and of course the ICMAP and other professional bodies, have always advocated that the appeal, if somebody is defaulted, the appeal can be done on the merit. It can't be dismissed. So whatever the information is available, it should be, the appeal should be, ex parte should be done, but it cannot be dismissed. So it is also was contradictory to the Rule 20 of the Income Tax Appellate Tribunal. So now the law has been amended. I'll just take our last 1 minute and then I will take leave from you. Then capital gain tax was introduced last year, and there was a clause inserted into the 147B5B that the advance tax should be paid within 7 days, which was inadequate, and especially in the case of the non-resident and those who know, those who are of you who know the securities business as a brokerage business, in the case of non-resident, 7 days is impossible. So now the law has been proposed to be amended, and it is now 70. It has been made from 7 to 21 days. I will not just discuss the slide, but I will just give you the write-off of irrevocable loans, section 18. What happened in 2002, the FPCCI and the State Bank of Pakistan and the other stakeholders, like a lot of textile companies, they went to the State Bank of Pakistan and they said there are a lot of non-performing loans and we can't pay actually. So the State Bank come up with the guidelines of this Circular 29 of 2002 and instructed to the bank how it should be, loans should be written off. And as we all know that nowadays there are a lot of hue and cry is going in the Supreme Court of Pakistan regarding the write-off of the loan. So now the explanation has been inserted into this 18.1, whereby any write-off which was given in 2002 or maybe later on 3, 4 and 5 will be considered as benefit and it can be taxed. So as I said, the insertion of an explanation means it was always there in the law in 2001. Although when this circular was issued, there were a lot of assessing officers finalized the assessment and they also take the note of it, and they said this is a benefit and it should be taxed. So there were a lot of appeals were filed. In the meantime, the clause 3A was inserted into the part 4 of the second schedule, whereby the application of the provision of clause 5 and 5A of section 34 and 35 was exempted. Later on, this clause was also